Hello and welcome to another edition of Focus on Alternatives. It's a joint video session between ADISA and Real Assets Advisors. And my name is Brian Bueller with Triton Pacific, and I'm joined with the CEO and founder of Griffin Capital, Kevin Shields. Kevin, thanks for joining us today.
Thanks, Brian. Thanks for having me.
So we're going to talk about office today, and the question I have for you is, what's the office climate? What's happening in the office space, and why invest in office?
Well, I'm going to make three overarching comments first. The first being that office as an asset class is probably the most difficult asset class to manage from a cash flow perspective, largely as a result of the normalized recurring capital expenses, tenant improvements, leasing commissions, and whatnot. So it takes an incredible focus to manage an office portfolio. I think the second thing really is that as I make general comments about the office market in general, you have to understand that the office market, and really all real estate asset class in general, are really locally driven. So the local demand and supply dynamics really affect what's going on in the office market and any other asset classes. And the third thing, Brian, is that the underpinnings for demand in the office market is largely driven by the underlying economy and what's going on in the economy. We are 9 years into this economic recovery cycle, and the economy continues to blossom. And as a result, the office market tends to be very resilient. But as we look at the office space and peel a layer down, we really look at it from a couple of different lenses. The first really is what's going on from the demand perspective, what's going on from the supply perspective, and how those two interact relative to the overall equilibrium in the market. So from a demand side, the economy, as I said, is pretty robust. We see very strong job growth. We see very strong GDP growth. I mean, we posted 4.1% in Q2. It looks like Q3 is going to come in somewhere pretty close to that. And then on top of that, we see solid, and strong positive business and consumer sentiment. And all those trends tend to operate favorably from a demand perspective. On the supply side, we've seen fairly muted supply deliveries over the last couple of years. We see accelerating costs to replace assets, both from a labor perspective. It's very difficult to find skilled labor to deliver assets in a timely fashion. Labor costs are accelerating. Supply costs, aluminum, steel, lumber, all accelerating. The consumer cost index is outstripping the CPI index by a factor of 150%. All of those things bode favorably in terms of the supply side, in the sense that the cost to replace the asset is increasing. And in a vacuum, that translates into real rental rate growth. So we're pretty constructive on the office market right now, and I could continue to go and dive a little bit deeper if you choose.
So let's talk about the various sectors of office and what influences those types of sectors.
So we really think about office really in two clumps, two groups. There's CBD office, and then there's suburban office. And as we look at the market and really particularly what's going on today, tenants seem to appear willing to pay a premium for new generation space. That's creating a little bit of flatness from a rental rate growth perspective on Class A office space. Deliveries are up strong on the forward pipeline. We're seeing 57 million plus of square feet that's going to be delivered through the end of 2019. That's going to create some downward pressure. 33% of that space is still available, so we're seeing a lower and lower percentage of pre-leasing activity. We're also seeing additions to supply through corporate office restructuring, operating efficiencies, corporate givebacks, restructuring of those spaces. Absorption is starting to slow in the space. We're down a third since 2017, this time last year. And that really is acting to shift the power paradigm between the tenants and the landlords in this space. And the tenants are starting to pick up a little bit more strength with respect to their ability to negotiate. Vacancy is rising slowly, albeit incrementally. We finished Q2 about just under 15% vacancy in the office sector. Rental rate growth is slowing after a couple of years of very robust growth. And interestingly, rental rate growth has been relatively flat in the CBD sector, but we're still seeing sustained growth in the suburban market as those two are tending to converge from a pricing perspective. One of the things that's concerning us as an office landlord is concessions are starting to bleed their way into the market in the form of higher TI work letters, longer free rent periods, increasing commissions, and ultimately we think those trends will continue to amplify over the next 24 months before we start to achieve equilibrium at the end of 2021 and into 2022 as the new deliveries through 2019 become absorbed. So if I could take a step back and think about how you as a sponsor are going to create value for your investors or your shareholders. The game of achieving value accretion as a result of cap rate compression is largely over, so we don't see that in the space anymore. So frankly, your ability to deliver returns to your investors is largely a function now of good old blocking and tackling and aggressive asset management. So again, we're constructive on the office space in terms of our ability to generate returns for investors, although we do see a couple of years of relatively slow growth over the next couple of years as we achieve equilibrium. And then as we take a further step back and look at the overall pricing paradigm, we look at the pricing in the context of the spread between triple Bs and cap rates. Over the last decade or so, that's been about 30 or 35 basis points. So we're above that, but we're inside of one standard deviation. So that to us indicates that real estate and the office market is relatively fairly priced right now in a market environment, by the way, where most asset classes feel pretty rich, either fixed income or equities, what have you. But as a general proposition, we think that the office market and the real estate market in general is fairly well priced at this point in the cycle.
Let's talk about lending for a moment. You've had various offerings out in the marketplace over the last decade, and you've had an opportunity to work with banks and other sources of capital. What's that market look like for office, in particular for your firm?
Yeah, it's still pretty strong. So we focus most of our office is long-term single-tenant net lease office and industrial. We've got about $5 billion of assets in a combination of a couple of REITs. And really, when you're buying long-term single-tenant, it's really a spread relationship that you're trying to target so that you can drive consistent and durable and sustainable returns to the investors. So you've got to really focus on a couple things. Make sure that you can borrow both equity and debt, deploy that capital in an accretive fashion in the REIT. And to do so from a debt perspective causes us to do a couple things, which is put in revolver and term debt on balance sheet, which is generally more aggressively priced, so you can create a larger differential and drive real value to the investors. But on the other side, because we're buying long duration assets, which are the leases associated with single tenant, you want to make sure that you're not mismatched from an asset liability duration perspective. So one of the things that we're very mindful of is looking at our weighted average duration on portfolio from a lease perspective and making sure that we're reasonably well matched from a liability perspective. So even if we finance ourselves with revolver debt or term debt, we are also incrementally breaking off chunks of assets and terming them out through either CMBS financing or insurance company financing. And the market is still very active and very robust from a debt perspective. Although, as a general proposition, as a REIT manager, our leverage quotient is relatively low. So on balance sheet and across of our fixed income, our fixed debt, we're probably 42 or 43% leverage. So as long as you're not pushing the leverage ratio too high, there's an ample amount of debt available in the marketplace.
Well, thank you, Kevin, for joining us today and talking about office, talking about your firm and your approach and outlook on where the office market may be headed. For those of you viewing, thank you for tuning in to another session jointly put together by ADISA and Real Assets Advisors. For more information about this particular session on office, please visit adisa.org or realassets.advisor.com. Thank you.